This idea of good, bad, and ugly is about, of course, technology, the 10-year treasury, and take inflation, right? And, there seems to be this dynamic in the market that every time the 10-year yield goes up, technology goes down in anticipation there will be Fed tightening responding to this higher inflation, which comes out tomorrow, probably, again, higher at 7% or maybe higher for headline inflation. So the market is preparing for a tighter environment. But I will say, though, Don, that although that can lead to choppiness in equity markets, the recent examples of history, let's say 2017-18 or even 2014-15, does show that equities can coexist with rising rates ultimately, because if the Fed is successful, inflation will start to moderate as the inflation responds to higher interest rates this year.
So Ben, I mean, is it possible for investors to be constructive on the U.S. markets in the face of what a lot of folks are anticipating to be multiple rate increases? I believe I was reading a note by Goldman Sachs. They're looking for 4 rate increases throughout the course of this year. Can you still be optimistic about markets given the fact that tightening is going to happen?
So I take comfort in that as inflation is much higher than we had in 2015 when we left off with rates, that yes, you could actually be somewhat constructive in U.S. equities for that reason. If those rate hikes, say 4, if that's the case, would impact inflation and bring that inflation down, it ultimately would be good for spending and real incomes, right? So that I think in a backdrop where the economy is still very strong, as we saw on Friday, payroll report was actually at full employment. So I think for that reason, you can remain positive on equities. On the other hand, there's also a lot of global opportunity, I think, against this rate rise we're seeing in the United States coming through. I think, for example, of emerging markets may be very different this time than previously. Emerging markets could perform better because of already having seen tightening there. So constructive in U.S. equities, but also in emerging markets.
What's the most compelling trade? You mentioned those emerging markets. Is there a compelling trade for you right now? I mean, we all know diversification is key, but what do you think is going to be the real outperformer? Is it that EM trade?
I would call it one of the outperformers. I think if you look at the United States, the small caps have interestingly shown resilience over the last number of weeks as we're starting to digest this rate rise scenario. So I think that's the other compelling trade. And then lastly, you do stay somewhat defensive in this environment. So I've always been on the more materials, energy, and healthcare side as well. So I think those 3 combined, emerging markets, healthcare, and small caps, I think are good thematic ideas going into this first quarter, digesting then a higher interest rate probably by the end of this quarter.